Hey guys, Brian Schroeder here with Buyers Club. I'm here with Jack Luttge with Jack Luttge Mortgage Advisors. That's a great name. Where'd you come up with that?
I picked the name Mortgage Advisor because that's how I think of myself. I'm more of an advisor to people. I'm not just a mortgage lender. I'm not just a mortgage broker.
Yeah,
I'm an advisor that's going to help you make the best decision for your situation.
that's
That's
awesome.
my thing.
I love that.
Yeah.
So let's talk about exactly what you do. So primarily you do DSCR loans. Is that
Yes.
correct?
Mm-hmm.
And maybe we should take just a second and explain the difference between a DSCR loan and maybe like a typical conventional loan.
Yeah.
Yeah. You want to do that real quick?
Yeah. So DSCR loans are what are called non-QM loans or non-qualified mortgages. So they're not backed by Fannie Mae or Freddie Mac or any of the big national investors. These are private loans from small banks, credit unions, small lenders. And so they're a little bit different. And the biggest difference with a DSCR loan versus a conventional mortgage is the underwriting on the income side of things.
Okay.
So, every loan you have kind of three criteria. You have your credit criteria,
Yep.
you have your income criteria, and you have your asset criteria, the property itself or your down payment money, whatever.
Okay.
So the asset and the credit are the same. We still need a good FICO score. You still have to have a property that's worth what you're paying for. You still have to have down payment money, all that good stuff.
Okay.
But the income is not based on your personal income. So when I take an application for a DSCR loan, I'm not asking for pay stubs. I'm not asking for W-2s or tax returns or any of that stuff. I don't need to do your debt to income ratio. We don't even ask for that. With a DSCR loan, the income is based completely on the property in question.
Okay.
When you're buying a rental property, and that's all these are for. These are for rental properties.
Okay.
So you can't do a DSCR loan for your primary residence. I've had people ask before.
Yep.
No, we can't do that.
Okay.
It is only for rental properties, and the rent that you're getting on the property basically has to pay the mortgage, the principal, interest, taxes, and insurance. And that's your DSCR ratio, debt service coverage ratio. So that's basically that's where DSCR gets its name. So It is the ratio of the rents versus the mortgage. If the rent covers the mortgage, you have a positive DSCR ratio. If the rent doesn't cover the mortgage, you have a negative DSCR ratio.
Okay. And so that was awesome. That was so I'm going to summarize that a little bit. So you do loans for investors that have single family houses, condos,
duplexes,
duplex,
four families.
Yeah,
all that stuff.
Bigger multifamilies, like
we have
20 units?
Yeah, even like mixed use properties.
Okay.
If you have like a commercial building with 3 residential buildings attached to it, something like that, we have a place for that.
Okay. And the underwriter's going to be running their credit.
I run the credit.
You run their credit.
They will review credit.
They'll review your credit as an investor, and they're going to send out an appraiser.
Yes.
But they're not going to ask you for your tax returns or your your W-2 statements. Okay. Fascinating.
Yeah.
That's great. And so let's talk a little bit about terms. Are most of them like 30-year fixed, or what are they like?
Yeah. The vast majority of my DSCR loans are 30-year fixed rate mortgages.
Okay.
We have other options. You can get an ARM, like a 5-1 ARM or 7-1 ARM. We even have interest only loans. We were just talking earlier about 10-year interest only loans. I just closed a couple of those back in January with 10-year interest only period, and then after that it switches to a 20-year fixed after that.
Gotcha.
But you probably want to refinance at that point.
Yes.
But yeah.
Fascinating. So there's a lot of flexibility in it.
There is.
Interesting.
Yeah.
Very good. What else should we know about him? Anything else that's unusual or?
Yeah. So a couple of important differences with DSCR loans versus conventional loans.
Yeah.
DSCR loans, they can close in the name of your business.
Okay, that's good.
So you can close a DSCR loan holding the title of the property and the loan itself in the name of your business, not your personal name. They do usually still require a personal guarantee, though.
Yep.
They're typically not non-recourse loans.
Okay.
But you can close in the name of your LLC. So that's another big benefit.
Yep.
Another big benefit of DSCR loans versus conventional loans is cash out seasoning.
Okay.
So a lot of investors doing the BRRRR method, they'll buy the house, fix it up real nice, and then they'll want to refinance, pay off hard money lender or whatever.
Yep.
But typically, in order to get any cash out, you have to wait a year for conventional loans.
Yep.
It's 1 year.
That's a long time.
Most of my DSCR lenders will do it after 6 months. Some of my DSCR lenders will do it after 3 months of
Okay.
seasoning.
And is that from the day they buy it or the day
Yes.
that, okay, not, they don't care about when the tenant moved in. The tenant could have
No.
moved in last week.
Yes, absolutely. Yeah.
But you do have to have a tenant with a lease in place.
Most of the time you do. I have lenders that'll do a DSCR without a tenant in place, but the terms aren't quite as good.
Yeah.
You definitely want to see a tenant in there. Yeah.
Gotcha. Gotcha.
Mhm.
That's awesome. Yeah. So basically, like we already talked about, I guess these are for investors with rental property. It's not for your fix and flip loan or anything like that.
Mm-mm.
Yeah. Investors with rental property.
Yep.
Anything else we didn't cover that an investor would want to know?
I think we talked about this a little bit before, but with the DSCR loans, I guess if you're comparing conventional loans versus a DSCR loan, like looking at the two options, I do have to say that conventional loans do have slightly better pricing.
Okay.
I priced out a variety of scenarios before now and looked at conventional loans versus DSCR loans.
Okay.
And on average for the same scenario, you're looking at about 0.25% higher interest rate for a DSCR loan versus a conventional loan.
Okay.
And DSCR loans do typically have prepayment penalties.
Yeah, that's a good
The
one.
standard prepayment penalty is typically about 3 years.
Okay.
And it's usually a 3-2-1 step down. So in the first year, your penalty is 3% of the loan amount. The second year, your penalty is 2%. The third year, 1%. After that, you can pay it off without penalty.
Okay.
So those are two things that kind of the bad side of DSCR loans that investors need to be aware of if they're comparing whether they should do a DSCR or do a conventional loan.
Yeah.
So
basically that prepayment penalty is if you're planning on selling or refinancing in the next year or two, it's probably not your best product if you can avoid it. But if you're going to own it for at least 3 years, you're confident you are, no big deal.
Yeah, absolutely. Yeah. And that is kind of a something that I talk to my investors about quite a bit because we don't know what rates are going to do in the next year or two. And we've had that conversation about, should we get a 3-year prepayment penalty if we think rates are going to drop?
Yeah.
And one of the really interesting things about the DSCR world is there are so many options. I have DSCR loans without prepayment penalties.
Okay.
The rate's higher.
Okay.
So then you got to figure out, okay, do I want to take a higher rate now to avoid a prepayment penalty, or do I want to just risk it and take the prepayment penalty knowing that if rates drop, I might not want to refinance so quickly.
Yeah.
Although if rates drop 2%, I'm just going to pay the prepayment penalty. I mean, I don't even care at that point. So I mean, it just got to roll with the punches.
Or roll with it.
Yeah.
And that's why you're a mortgage advisor.
That's right.
I like that.
I'm here to help you make the best decision.
Awesome.
Yeah.
Well, thanks for coming in, Jack. I really appreciate it.
Thank you very much.